A few days from now, the most powerful financial institution in the world, the Federal Reserve, is getting new leadership. We have the Fed Reserve Chair changing hands from Jerome Powell over to Kevin Warsh, and the Fed just recorded its most divided vote since 1992. It doesn't look like rates are going anywhere fast, and most real estate investors are not paying attention to this one thing that could be a very expensive mistake. So today, we're breaking down what the Kevin Warsh era means for your cost of capital, your next acquisition, and how to position yourself before the market reprices. Coming right up. Hey, what's going on, guys? Welcome back to the Millionaire Mindcast. As always, your host, Matty A. If you are new here, this is where we talk real wealth, right? Real wealth, real strategy, real world investing. Of course, real estate, that's my jam. No fluff, no theory, just the stuff that actually will arm and equip you and move the needle in a way that helps you build your wealth and income. So if you haven't hit the subscribe button already, as always, I invite you to join me for multiple episodes each and every week. So let's set the scene. What just happened? Well, as of this week, the Federal Reserve held interest rates steady, as you guys know, for the third meeting in a row at 3.5 to 3.75%. So no cuts. And the experts, at least from what we're seeing in the dot plot, aren't expecting any for the rest of 2026. Now, I know you've heard Mr. Breedwell on our Money Moves Wealth Building Wednesday episode say he thinks there's still one on the table in July. That's kind of his bold prediction. But a lot of people are pretty convinced that we're going to see a pause through the remainder of the year. Now, everybody knows Trump is nominating Warsh because he believes there's a dovish sentiment and he will cut rates. But Warsh, as well as Powell, as many of the other federal governors have all said, hey, we're keeping politics outside of what the Federal Reserve does here. That separation is critical to the trust and the stability of the economic machine that is the U.S. economy. So no rate cuts for 2026. Well, why? Well, as we all know, a war involving Iran has sent oil prices past $100 a barrel. It's spiking up, it's spiking down. There's concerns of inflation continuing to creep back in, which honestly was what the Fed was fighting against over the last few years post COVID era. They were hoping that, inflation was going to continue to keep falling. Well, it has slowly started to tick back up to 3.3% year over year. Now, this is not anything substantial based on what we saw in previous years, but it's still trending back now in the wrong direction. That's the highest annual inflation rate in nearly 4 years. Meanwhile, the 30-year mortgage rates as of today, when I'm recording this, May 5th, are sitting at 6.22% and seem to be climbing. The Mortgage Bankers Association and Fannie Mae are both projecting rates stay between 6 and 6.5% through the end of the year. So that doesn't really stimulate the real estate economy in any way on the single family side. It definitely doesn't help a lot of the debt maturities that are coming due in the commercial space on adjustable rate mortgages, people needing to refinance. So if you've been underwriting deals assuming a rate drop by Q3 or Q4, you really should go back to your spreadsheet today. You should be a little bit more conservative and ideally price in something that isn't going to be cheaper than where we're at today. I mean, I would say even be more conservative and price in something maybe a little bit more expensive just to be safe. But here's the bigger story. Jerome Powell, the man who navigated the entire post-pandemic inflation battle, whether you liked him, you didn't like him, you think he did a good job or not, his era is coming to an end. He's stepping down as Fed chair on May 15th, which is 10 days from now. His replacement is a guy named Kevin Warsh. He's a former Fed governor as well. He's a Morgan Stanley executive, and he is Trump's nominee who just passed his Congress, or I believe Senate hearing, and is moving through his confirmation right now. And here's what makes this moment unusual. Powell's final FOMC meeting ended in an 8-4 vote to hold rates. So we had 4 members who dissented from the rest of the group. The last time the Fed was that fractured was 1992. And the institution that controls the cost of every dollar you borrow as an investor is in its most divided state in over 30 years, right as it's handing off to new leadership. So that's not just background noise. That's not just something to breeze over. That is the story to be paying attention to. So who is this Kevin Warsh guy, and why does all of this really matter to you as an investor? Well, let me give you a quick profile on Warsh first, because he is the guy, in my opinion, that is going to change a lot of, call it financial policy going forward, the sentiment, the outlook, and actual real world results within the Fed, because who this guy is changes how you should be thinking about the next 12 to 18 months. So Warsh is historically known as an inflation hawk, someone who leans towards keeping rates higher to fight inflation, which is a little bit contradictory to what we all know Trump wants. But he's coming in under a president who has been very vocal, obviously, about wanting cheaper money. So there's a push-pull dynamic here before he's even sat in the chair, before he's even been, confirmed and made any of his first decisions, first speeches. So here's his worldview in plain English. He believes AI is deflationary, meaning technology will make the economy more productive and create space for rates to come down without reigniting inflation, which is positive for rate cuts. He also wants to shrink the Fed's footprint in financial markets, which is a massive philosophical shift from how the central bank has operated since 2008. So think of it this way. Powell was kind of the careful, safe, methodical pilot. Data first, move very slow. Let's see how the data plays out. He was very communicative around everything. Warsh is going to be the new pilot who thinks the plane was maybe built, maybe not wrong, but maybe he wants to redesign it, and he wants to do that mid-flight. So now that might be visionary. It might even be right. I don't know. We'll see. But it creates something markets hate above all else, which is uncertainty. And here's the line that I want you to remember from Simplify Asset Management's head of multi-asset solutions. He said, anytime the markets get complacent, whether in equities or bonds, that is usually when volatility strikes. And guess what we're seeing right now? Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Amagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple. Focus on first position asset-backed lending, just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. So we are in a complacent moment. Stocks near all-time highs or continue to hit all-time highs and then have little pullbacks. We've seen multiple all-time highs this year in many asset classes, many indices. Credit spreads are historically tight. There's potentially a private credit bubble that is, fears are stoked around that popping. The new Fed chair walking in the door in 10 days is obviously going to shake some things up. So the combination of all these things, in my opinion, deserves our full attention. This is a wild time right now. It's a great time to be an investor. It's also an uncertain time to be an investor, very volatile time. So what does this mean for your portfolio? Whether you're in real estate, you're in stocks, crypto, I mean, it impacts everything. So let me translate this into 3 things that actually matter for real estate investors, specifically knowing that that is my identity. In my opinion, I would say forget rate cut for 2026 right now. If it happens, great, icing on the cake. If it doesn't, at least you planned for it. And if you want to be ultra conservative, maybe you hedge a little bit and you bake in a 25 basis point jump for, particular unknowns that could play out, being that there are a lot of those variables in the landscape right now, geopolitically, around the world, economically. So these are things that maybe you want to be a little bit more cautious on. So in my opinion, I would just suggest stop building deals around an assumption that borrowing costs are coming down meaningfully before year end. The base case from every major institution, you got Fannie Mae, MBA, the most serious analysts in the game, is 6 to 6.5% for the remainder of 2026. So underwrite to that reality. The hopium is what got a lot of people in trouble in many of their deals. So anything better than that is, of course, upside and alpha that you're going to get, but it shouldn't be your base case plan. Now, number 2 is floating rate debt is real exposure. So if you're sitting on bridge loans, construction debt, or any variable rate instrument, your refinance window and your exit assumptions are directly tied to what Warsh does in his first few months. Now, the bear case here is real for a lot of people. If he cuts too early with inflation still running hot, the Fed loses all credibility right out of the gate. The bond markets are going to spike and your refi environment is going to get way worse, not better. So stress test your debt at 6.5%, 7%. If the deal doesn't survive that scenario, it honestly, in my opinion, shouldn't get a hard look. It's better to not do a deal right now than to force doing a deal. And that is really hard for me to say because sitting on my hands in these kind of markets is painful. But that being said, I think these are the times that you really have to exercise the discipline with your investment strategy, your investment portfolio. Now, number 3 is the transition window is a buying signal. So if you're positioned correctly, this could be honestly what sets you up for the next decade, multiple decades. So here's something that gets overlooked. When a new Fed chair takes over, institutional capital tends to pause for 60 to 90 days while the market figures out what new leadership means. That creates a brief window of hesitation. So you've got fewer competing bids, fewer buyers, softer pricing, motivated sellers who honestly are just looking for that clarity. Now, the investors with dry powder and conviction in their underwriting will use that window as opportunity. So the investors waiting for certainty before they act will miss it. And as Warren Buffett put it, be fearful when others are greedy and greedy when others are fearful. This is the definition of that window. And that window may be cracking open right now. So we'll have to pay attention to that. Now, here's what I want you to walk away with from today. The most dangerous assumption in real estate right now is that rates will cooperate before your next deal needs to close. We are in a genuine transition. We've got a divided Fed right now. We've got the new Fed chair that is coming in with a new philosophy. We've got, potentially stickier inflation than many people want to believe. And the geopolitical pressure with what's going on in Iran, you still got, some of the tensions going on between Ukraine and Russia. There's a lot of things going on right now, driving oil prices higher. These variables don't resolve themselves just because you need them to, and they don't do it overnight. So the investors who win in this cycle are the ones who plan for the world as it is right now, not the world that they think it's going to be here very soon. So just be realistic about that. But also, again, just stick to your plan, be safe, don't have rosy assumptions, and continue to execute. I always think of like Mike Tyson's statement of everybody has a plan until they get punched in the mouth. Well, the punch is coming, and have a plan before it lands. So this week, go look at your debt maturities, review your rate assumptions, have an honest conversation with your lender about what, your refinance or your term sheets look like. Pencil those in accordingly, give yourself a little bit of buffer room. And if you haven't stress tested your portfolio for higher, for maybe longer, that's something to maybe take a look at. Just stay macro aware. Yes, the short term, sprints are noise, but you want to look at the bigger picture, preserving and protecting capital, protecting your deals. Live to fight another day, because this is a long game. So stay sharp, keep building. As always, appreciate you guys tuning in. Keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers. Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.